Hi, this is Julieta Yang Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 8 about property, plant, and equipment. I discussed in part 8 about acquisition by donation. Just click above or the link below this video to watch part 8. In this video, I am going to discuss about acquisition by self-construction. Acquisition by self-construction. Some entities construct assets for their own use rather than buy one that is ready for use. The cost of a self-constructed asset is determined using the same principles as for an acquired asset. If an entity makes similar assets for sale in the normal course of business, the cost of the asset is usually the same as the cost of constructing an asset for sale. Therefore, any internal profits are eliminated in arriving at such costs. Similarly, the cost of abnormal amounts of wasted material labor or other resources incurred in self-constructing an asset is not included in the cost of the asset. IAS number 16, Property, Plant, and Equipment, paragraph number 22. Two critical accounting issues arise in accounting for self-constructed assets, namely, first, allocation of indirect manufacturing cost, and second, interest capitalization. Allocation of manufacturing overhead. Minimal problems are encountered in accounting for the direct costs incurred in self-construction, such as direct materials and direct labor. In addition to these direct costs, the self-constructed asset should likewise be charged with a portion of the manufacturing overhead incurred during the construction period. The amount of the manufacturing overhead charged to the self-constructed asset may be equivalent to, first, its fair share using the same basis of allocation for manufactured inventory, or number 2, the incremental amount or indirect manufacturing overhead. Consider the following illustration. NSR Builders is a company that is engaged for constructing building for its clients. During the current year, it also constructed a building for its own use. The following information related to its usual operations and building construction is made available to you. Direct material. Building constructed for clients, 50 million pesos. Building constructed for own use, 8 million pesos. Direct labor. Building constructed for clients, 45 million pesos. Building constructed for own use, 5 million pesos. Total overhead incurred during the current year amounted to 48 million pesos. The company normally applies overhead to production at the rate of 90% of direct labor cost. Determine the total cost of buildings constructed for clients and building constructed for own use, assuming that A. Overhead is charged to normal operations and to building for own use based on direct labor costs. Letter B. Normal operation is charged with overhead at its normal rate based on direct labor costs, and any incremental overhead is charged to building constructed for own use. Solution. Letter A. Assuming that overhead is charged to normal operations and to building for own use based on direct labor costs. Direct material. Building constructed for clients, 50 million pesos. Building constructed for own use, 8 million pesos. Direct labor. Building constructed for clients, 45 million pesos. Building constructed for own use, 5 million pesos. Overhead, 48 million times 45 over 50. Buildings constructed for clients, 43,200,000 pesos. 48 million times 5 over 50. Building constructed for own use, 4,800,000 pesos. Total cost, building constructed for clients, 138,200,000 pesos. Building constructed for own use, 17,800,000 pesos. Letter B. Assuming that operation is charged with overhead at its normal rate of 90% of direct labor costs and any incremental overhead is charged to building for own use. Direct material, building constructed for clients, 50 million pesos. Building constructed for own use, 8 million pesos. Direct labor, building constructed for clients, 45 million pesos. Building constructed for own use, 5 million pesos. 45 million times 90%, building constructed for clients, 40,500,000 pesos. 48 million less 40.5 million. Building constructed for own use is 7,500,000 pesos. The total cost for building constructed for clients is 135,500,000 pesos. For building constructed for own use is 20,500,000 pesos. Borrowing cost. The cost of borrowing may be included in the cost of a self-constructed asset if it meets the criteria for the recognition of interest as a component of the carrying amount as provided in IAS number 23, borrowing cost. Borrowing costs are costs incurred related to borrowing transactions and include interest paid and accrued, amortization of discounts, premiums, and ancillary costs incurred in connection with the borrowing arrangements, and exchange differences arising from the foreign currency borrowings to the extent that they are regarded as an adjustment to interest costs. Borrowing costs that are incurred in the period during which no qualifying asset is being constructed is recognized as finance costs in profit or loss in the statement of comprehensive income. Finance costs taken to profit or loss are required to be presented separately on the face of the statement of comprehensive income under IAS number 1. Presentation of financial statements. Borrowing costs incurred during period of construction of qualifying assets are treated as part of cost of the qualifying asset subject to the limit set by IAS number 23. A qualifying asset is a discrete project of an enterprise that takes substantial period of time to get ready for sale or use. Borrowing costs are capitalizable as part of the qualifying asset being constructed if all of the following conditions are met. Number 1, there are actual borrowing incurred by the enterprise. Number 2, actual borrowing costs are incurred. And number 3, construction of the qualifying asset is ongoing. There are 2 exemptions cited by IAS number 23 on the capitalization of borrowing costs. First, borrowing costs incurred relating to qualifying assets that are measured at fair value, such as biological assets and investment property measured at fair value. And number 2, borrowing costs incurred relating to inventories that are produced in large quantities on a repetitive basis. It means, therefore, that relevant borrowing costs incurred on the construction of the qualifying assets, except as noted earlier, are capitalized. Borrowing costs not capitalized are treated as finance costs and are taken to profit or loss during the period in which they are incurred. The amount of borrowing costs capitalizable will depend upon whether the borrowing is a specific borrowing or a general borrowing. Specific borrowing is one that is obtained by the enterprise to finance solely the construction of the qualifying asset. A general borrowing is one that is obtained by the enterprise to finance the general requirement for funds of the enterprise. Proceeds of such borrowings are used partly to finance the asset construction and partly to finance working capital and other fund requirements of the enterprise. Assets financed by specific borrowings only. If the entity incurs only specific borrowings during construction, the borrowing cost capitalizable is actual interest incurred on that borrowing during the construction period, less any interest income on the temporary investment of those borrowing proceeds. Assets financed by general borrowings. If only general borrowings are incurred during the period of construction of the qualifying asset, the borrowing cost capitalizable is the lower between. First, actual interest costs incurred during period of construction, and number 2, weighted average accumulated expenditures multiplied by the weighted average interest rate. Assets financed by both specific borrowings and general borrowings. If the qualifying assets cost is financed by both specific borrowings and general borrowings, the borrowing cost capitalizable should be computed based on the assumption that weighted average accumulated expenditures in excess of specific borrowing are financed by general borrowings. The borrowing costs eligible for capitalization would consist of 2 items, namely A. Actual interest incurred on a specific borrowing less any interest income on temporary investment of those borrowings, and letter B, the lower between actual interest costs incurred on general borrowings during period of construction and weighted average accumulated expenditures minus specific borrowings times the weighted average interest rate on general borrowings. To illustrate, assume the following data for DEF Company. DEF Company made the following disbursements in relation to the construction of its building, which started on January 1st and was completed on December 31st. January 1st, 10 million pesos. March 31st, 5 million pesos. June 1st, 6 million pesos. August 1st, 3 million pesos. December 31st, 1 million pesos. Case 1. On January 1st, 2009, DEF obtained a loan for 20 million pesos at an interest rate of 10%, specifically to finance the construction of its building. Prior to their disbursements, the proceeds of the loan were temporarily invested and earned interest income amounting to 100,000 pesos. Analysis. Since construction was financed solely by the specific borrowings, computation of average accumulated expenditures is not necessary. Capitalized interest is actual interest on a specific borrowing 20 million pesos times 10% is 2 million pesos, less interest income 100,000 pesos, total interest added to the cost of building 1,900,000 pesos. Hence, The total cost of the self-constructed asset is 25 million plus 1,900,000 pesos, or a total of 26,900,000 pesos. The entries for the interest are as follows: debit building for 2 million pesos, credit cash or interest payable 2 million pesos, interest on specific borrowing. Debit cash or interest receivable 100,000 pesos, credit building 100,000 pesos, interest on temporary investments. Case number 2. On January 1st, 2009, DEF obtained a loan for 12 million pesos at an interest rate of 10%, specifically to finance the construction of its building. Interest earned from temporary investment of the proceeds of the loan prior to their disbursement amounted to 100,000 pesos. Other loans of DEF, part of which were used for the construction activities, is as follows. Date obtained January 1st, 2008, term 5 years, interest rate 7.5%, amount 10 million pesos. January 1st, 2009, term 2 years, interest rate 12%, amount 20 million pesos. Analysis. Since there are outstanding general borrowings during the construction period, the first step is to compute for the average accumulated expenditures as follows. 10 million pesos times 12 over 12 is 10 million pesos. 5 million pesos times 9 over 12 is 3,750,000 pesos. 6 million times 7 over 12 is 3,500,000 pesos. 3 million pesos times 5 over 12 is 1,250,000 pesos. 1 million times 0 over 12 is 0. The average accumulated expenditures is 18,500,000 pesos. The average accumulated expenditures, 18,500,000 pesos, financed by specific borrowings, 12 million pesos, financed by general borrowings, 6,500,000 pesos. Capitalized interest is computed as follows. On specific borrowing, 12 million times 10% is 1,200,000 pesos, less interest income of 100,000 pesos, a total of 1,100,000 pesos. On general borrowings, the lower between A and B. A, 10 million times 7.5% is equal to 750,000 pesos. 20 million times 12% is 2,400,000 pesos. The total of 3,150,000 pesos. Letter B, 6,500,000 pesos times 10.5% is 682,500 pesos. 10.5% is the weighted average interest rate on the general borrowings, which is 3,150,000 pesos divided by 30 million pesos is 682,500 pesos. The total interest added to the cost of building is 1,782,500 pesos. Hence, the total cost of the self-constructed asset is 25 million pesos plus 1,782,500 pesos, or a total of 26,782,500 pesos. The entries for the interest are as follows. Debit building for 1,200,000 pesos, credit cash or interest payable for 1,200,000 pesos, interest on specific borrowing. Debit cash or interest receivable 100,000 pesos, credit building 100,000 pesos, interest earned on temporary investment of specific borrowing proceeds. Debit building, 682,500 pesos. Debit interest expense, 2,467,500 pesos. Credit cash for interest payable, 3,150,000 pesos. Interest on general borrowings. Case number 3. DEF had the following general borrowings during 2009 that were used to finance the construction of the company's new building. Date obtained January 1st, 2008. Term 5 years. Interest rate 7.5%. Amount 10 million pesos. Date obtained January 1st, 2009. Term 2 years. Interest rate 12%. Amount 20 million. Analysis. Since there are no specific borrowings, the interest cost capitalizable is the lower between A and B. A. Actual interest cost incurred. Interest rate 7.5%. Loan amount 10 million. Interest cost 750,000 pesos. Interest rate 12%. Loan amount 20 million. Interest cost 2,400,000 pesos. Total of 3,150,000 pesos. Letter B. Weighted average accumulated expenditure of 18,500,000 pesos multiplied by weighted average interest rate of 10.5% is 1,942,500 pesos. The capitalized interest is 1,942,500 pesos. Hence, the total cost of the self-constructed asset is 25 million plus 1,942,500 or a total of 26,942,500. The entry for the interest is as follows. Debit building for 1,942,500 pesos. Debit interest expense for 1,207,500 pesos. Credit cash or interest payable for 3,150,000. When the expenditures for a self-constructed asset were incurred evenly during the construction period, the average accumulated expenditures are simply taken as the simple average of the total amount of expenditures. Thus, if the total amount of 25 million was incurred evenly during the construction period, the average accumulated expenditure is 12,500,000 pesos, which is 25 million divided by 2. Thereafter, the computation of capitalized interest would be similar to the earlier illustrations. Thank you for watching my video. I hope you learned something from this video. I did part 10 and continuation of this video wherein I discuss in part 10 about acquisition under finance lease. Just click above or the link below this video to watch part 10. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Julieta Yang Orfiano. See you on my next video.